Timing is everything in financial markets. When you're an investor, it doesn't matter if you're right about everything unless you get the timing right as well. So what if I could tell you that there's a financial indicator which predicted quite accurately 12 of the last financial crises in the last 150 years? Central banks pretend it doesn't exist. Academics try to discredit it in shoddy fashion, but it's still there for investors willing to listen and to think for themselves. Today, I'm going to introduce you to that indicator, but first I should introduce you to the person who wrote the book that showed me the indicator, Dr. Mark Thornton. Thanks very much for joining us.
Hey, it's great to be here and be on your podcast.
It's a pleasure to have you.
Thank you for having me. Yeah.
And thanks for all the work you do as well. I've read a lot of it over the years, and I appreciate it a great deal. But let's focus on your book, The Skyscraper Curse, and how Austrian economists predicted every major economic crisis of the last century. Now, I know a lot of people are going to dismiss this idea of a skyscraper curse. They've probably heard about it in passing. Is it real?
Absolutely, it's real. It's got a track record that's more than a century long. It's very accurate. Every major financial publication dismissed this indicator when it was first mentioned in the news. And then they were completely surprised when the Burj Khalifa Tower set a new record in 2007, ushering in, a global economic crisis, really, in the Middle East, in Europe, in the United States and Canada, and virtually every place around the world was suffering as that skyscraper was reaching its completion.
Yeah, that's one of the key lessons here is this isn't a load of hindsight. This has actually already been used by yourself and other investors to predict a financial crisis, not just that one, also the European sovereign debt crisis, I believe. But let's get to that a little bit later. I want to quickly sum up what this video is going to be about, because I think the best bit is at the end, as far as I'm concerned. But people need to understand a lot in order to get there. So as I see it, the book does three things, at least the first half of the book, which is what we're going to focus on today. The book creates an updated version of the skyscraper curse. I think of it as your version or the Austrian School of Economics version. And it shows how accurate that version of the skyscraper curse is. It also sort of digs through the attempts by mainstream economists to discredit the skyscraper curse, which I found to be the funniest part of the book because it makes them look either stupid or worse. And that explanation is a good way to understand the accurate version of the skyscraper curse. And last but not least, it explains the why behind this. So a lot of people are dismissing it, I'm sure, in their minds right now, because it sounds like it's just, skyscrapers predict financial crises. That's ridiculous. But actually, once you dig into all of this, it makes a lot of sense. Let's begin, though, with the original version of the skyscraper curse from 1999.
Very good. Andrew Lawrence, a financial analyst working out of Hong Kong, wrote up the skyscraper index as he saw it for the 20th century. And what he found was that every time there was a record-setting skyscraper in terms of heights, in terms of livable space, that the economy soon went into an economic depression. And very often it was a worldwide economic crises. And that held true from the early days of the 20th century, the Panic of 1907, and it continued through the Great Depression, through the stagflation of the 1970s, the tech stock bubble of the end of the century, and then he only had one exception to that rule, which was the Woolworth Building, which did not coincide with a GDP economic crisis. And so he laid out the plan. He didn't have a connection as to why this was the case. He just brought it forth to his readers, his investors, in his company, and then he wrote it up for the media, and the media scoffed at it. They just thought it was an easy story to write and an easy story to dismiss. Everybody loves skyscrapers for one reason or another, but they didn't want to be telling people that it was good financial advice at the same time as it's good architecture and good theater and good backgrounds for movies and so on and so forth. So that was Andrew Lawrence, and I give him a lot of credit for that.
He didn't take his own theory very seriously, though. He called it the skyscraper index faulty towers. So it seems to me that from the very beginning, people have been, I mean, shy or awkward about whether this is even credible.
Absolutely. He didn't put any context to it. He didn't give an explanation for it. He sort of laughed it off. He didn't respond to my emails. And I thought he was dead at one point, but, and, and the media went along with that. Now, when I read the newspaper and I saw that story, immediately a light bulb went off in my brain that said this connects to the Austrian school's understanding of the business cycle. And I was always a micro public policy type of an economist, but I always had a great interest in macroeconomics and monetary economics and the business cycle. And so I immediately began studying it within that context, both the connection theoretical as well as the index that he had created. And I started to go back and look at some additional data.
Yeah, and you updated the theory to link into the Austrian understanding, which is the best part of the book. But the funniest part of the book is when you look through the attempts of the mainstream, both the magazines and the newspapers, but also proper academics, and their attempts to debunk this idea. Do you want to take us through some of the examples of how? I mean, it's a perfect case of what we call the straw man argument, isn't it?
Oh, absolutely. And, there are not just real estate economists, but there are actually a few people who do research basically on skyscrapers and, what that does to an economy. There's all sorts of micro problems with skyscrapers. And then there's various signals for macroeconomics. And their work, of course, touched on things that I talked about, but obviously they didn't really like this idea of the skyscraper curse, that the skyscraper could be the cause of an economic crisis, which I never said, but which everybody believes for some reason. And without them notifying me in any way, they published a paper debunking the skyscraper index. And they took data that really doesn't apply, like just the largest building in major countries. That's not really record-setting skyscrapers in my book. And they looked at, standard GDP analysis and recessions, none of which really are attributable to the skyscraper curse. We're looking at basically two things: the height in terms of the number of floors of livable space, and we're also looking at major economic crisis. So if you're trying to do a regression that has, GDP and recessions declared by the National Bureau, and you're looking at just the tallest building in several countries, that's really not the skyscraper. So you're really not testing the skyscraper index or the skyscraper curse. But they went on and they said, well, we don't find any evidence of skyscrapers in the economy, but we do find evidence that those are just co-varying with one another. In other words, one doesn't cause the other. It's the two things, skyscrapers and the economy, are moving hand in hand with one another. Like when I walk my dog, I walk a straight path, my dog does not. And but we're both walking the same general path. So that's the statistical idea about the data, but that's exactly what I'm saying, is that skyscrapers and the macroeconomy move together at critical junctures, but they're caused by a third factor. And that third factor is interest rates. And that's what a good part of the book delves into, is making the connection between interest rates in the economy and both skyscrapers and the macro economy. So, in other words, when they found covariance between those two data series, what they were doing is supporting me, even though in the paper they said it's basically saying that I'm wrong about the skyscraper curse. And so a friend of mine noticed the statistical problems in their work, and we wrote a paper describing the problems with the first set of data that I described previously and this covariance factor. And it's standard analysis. We had other econometricians look at it. They found it was fine. And yet the journal that originally published this negative paper on the skyscraper curse rejected the article. And, you know, we're not sure why exactly they didn't publish it, but one of the referees, it's important to notice, one of the referees mentioned in his comments that he was one of the authors of the original study, which we found very unprofessional to allow somebody that we're being critical about to essentially veto our paper. And so we were very upset with that journal. Applied Economics is what it's called. And they publish all sorts of short papers, on finer details and follow-up studies and just the kind of thing that we were doing. And yet they rejected it without any option of resubmitting. So that was very disheartening. And it probably would have been the worst thing that happened to the skyscraper curse if it hadn't been for The Economist magazine doing something very similar.
I have a quote here, which made me laugh a lot when you wrote about it. It's from The Economist magazine. You cannot accurately forecast a recession or financial panic by looking at either the announcement or the completion dates of the world's tallest building. Now, what's funny about that is you don't point to either of those dates in the skyscraper index. So it's sort of a bit stupid to comment on it in that way.
Absolutely. And we pointed that out in our reply. Announcement dates happen all the time. People announce record-setting skyscrapers all the time. And sometimes it may not be for 10 years. Like with the World Trade Towers, it took them over 10 years to break ground on that. So that's obviously not going to hold up. And then, of course, a lot of a lot of announcements never break ground. And so we paid attention to the groundbreakings because that means, you've tested the bedrock, you've passed environmental tests, you've passed city regulations, you've passed dozens of major steps and hundreds or thousands of minor steps of engineering and compliance. It's really an incredibly complex process. So if groundbreaking is a signal that you've passed virtually everything and you're ready to go, and you have a very good idea of the project you're going to build. Now, we also focused in on not completion or opening dates, but whenever the skyscraper actually broke the record, we felt was the most justified theoretically, and also the date that worked well with historical experience. So that's why in 2007, I think it was August of 2007, I put out an internal memo and on our blog about the Burj Khalifa Tower setting a new record height in the Middle East. And nobody pretty much paid attention to that. Well, that building wasn't actually completed and opened for another 3 years. And at the time that it reached the record height, Dubai was on top of the world, so to speak, no pun intended. And in 2010, when the building opened, they were bankrupt. And that's the first time anybody noticed little old Mark Thornton in Alabama, who had made this prediction that things were going to look really bad, both in Dubai and in the Middle East, but also most likely globally as well.
Yeah, so just to hone in on it specifically, it's the date that construction hits new record highs. It seems to me that you're being very polite here. When I wrote about this, actually, what occurred to me is it's canary fart analysis. So I feel like these economists have said, canary farts do not kill coal miners. Well, yes, but canaries are brought into coal shafts for a different reason, and they're an indicator of an imminent crisis. And so if your canary drops dead, you probably need to get out of the coal mine. That's how I think about this. Let's move on to your understanding, your version of the skyscraper index with a little bit more detail. So it's the day that construction hits record heights. Is there any other sort of conditions, and what's the time frames that you're talking about here?
Well, it has to be of livable space too. There's a whole set of records for absolute height. There's another record for absolute height with antenna or spear or any other object rising above the livable space. So livable space, as well as the floors that contain utilities, because these buildings are so high that every 40 stories, they need a whole floor just for air conditioning, heat, that kind of thing. But that counts in terms of floors because it's the same sort of conditions. And so we're looking at livable height with all the systems working, elevators and all that, water, fire, electric, communications, all the complexities of the skyscraper have to be there. And we look at the record-setting date. If we're talking about record-setting skyscrapers, well, the most obvious date to be looking at is when they're completed, not when they're opened or not when they're announced, basically. But those you need to be very careful with investments and with the economy, with economic policy, macro policy, stabilization policy. You must be getting very concerned as you approach that date and realize that at that date, things might be as good as it gets or better than you ever thought it was or would get. But the skyscraper curse predicts that the catastrophe or the crisis is likely pretty close in the future. It could be 6 months, but it's most likely going to happen within a couple of years.
Without going through the list of, I think it's about 12 or more crises that this new index has predicted, what do the results look like in general terms? What's its track record? Is it 100% track record or close, or what's the general sort of, I guess, the performance of the index?
Well, the performance is very good. We backdated the study into the 19th century, and that goes back to the beginning because until 150 years ago, the highest building for standard living was 4 stories. And the reason was it was hard to build structurally, and it was hard to walk up and down every day. And so when the elevators came and steel beam construction came, that's when the skyscraper took off, so to speak. And so the last 25 years of the 19th century we looked at, those all basically conformed very well. And then we pick it up with the Panic of 1907, 2 records. The Great Depression, we had the Chrysler Building in 29, Wall Street Building in 1930, and then the Empire State Building in 31. All of those were under construction during the last phase, or the beginning phase, really, of America's Great Depression and the worldwide depression that it ushered in. Now, we fast forward until 1970, when we got the World Trade Towers in New York at 110, and we got the Sears Tower in Chicago, all relatively the same height, but more floors and more livable space than those of the 1920s. And so that ushered in the global economic crisis, which in the United States it was referred to as the stagflation of the 1970s. It lasted roughly from 71, when those buildings were setting records, until 1982. And then after that, we had the tech bubble. In the tech bubble, of course, during the 1990s, we had a great stock market, unbelievable stock market, irrational exuberance, and all of that. And we had a new record set in Malaysia, the Petronas Towers, and then we had Taipei 101. Excuse me, the Taipei 101 building in Taiwan. And those sort of were bookends for the tech stock bubble and bust. And that's where Lawrence, he set the stage for that one. And then, of course, we had the Burj Khalifa Tower telling us about the world financial crisis in 2007. So that's basically where it was. And I've been looking, of course, at skyscrapers, skyscraper construction, particularly a building in Saudi Arabia. And it doesn't tell us a clear story, but it tells us a lot about the world economy and the financial environment that we're in right now.
Yeah, that's where we'll finish. I want to turn this thing around and say, oh, actually, first of all, I want to mention your claim is not that all financial crises are going to be predicted by a new record skyscraper. The claim is that when there is a record skyscraper, there is a high likelihood of a crisis. So that's another, I guess, straw man attack that I'm sure you have to put up with. Let's move on to the why. It seems to me that there's two ways to approach this story. One is to notice that whenever there's a financial crisis, actually there was a record skyscraper just preceding it. The other angle, which I want to dig in from now, is that if you understand Austrian economics, it would make perfect sense to you if a record-breaking skyscraper would precede an economic or financial crisis, because, take it away.
Okay, well, the Austrian view is that interest rates that are artificial rather than market determined have a big influence on entrepreneurs and investors. And building the world's record skyscraper is like the pinnacle of entrepreneurship and investing and good feelings about the economy. But what's going on underneath within that skyscraper is that the interest rates are doing several things. One is that every real estate person knows is that when when interest rates are low, land prices are high. And there's a very solid inverse relationship there. And when land prices are high and you want to build, the only way you can make it profitable is to build taller. A second factor that every industrial organization economist realizes is that low interest rates encourages mergers and acquisitions and for firms to grow internally. So you have three forces which lead to larger firms, national firms rather than local firms, global firms rather than national firms. So they merge, they buy out companies, they get bigger. And basically what you're doing to the world is telling it mom and pop operations have to go away and corporate operations have to take over. And, corporate operations, if they're national and global, they need headquarters. And headquarters are almost always in central business districts. So all of a sudden you increase the demand for central business district space, like in London and New York and Tokyo. And in order to facilitate that, you also build higher. And the third thing that we looked at with these low interest rates is just all the technology involved in building and in designing these skyscrapers. Everything, when you go 10 stories higher than anybody's ever gone before, you literally have to rewrite the book about design, engineering, architecture, and then all of the building systems, air conditioning, elevators, escalators, communications, airflow, heat, water, sewer. The list goes on and on. I'd never want to build a skyscraper myself. It's that complex. But if all of these companies are rewriting their books and they're inventing new techniques and new technology to make these things possible, and the best example I have of that is a company in Japan who invented a new, essentially, heating and cooling system that no longer relied on big ductwork and vent work, but instead simply had small pipes that moved the coolant and the heating and the heat and the cool through smaller pipes, so that you could literally heat and cool much larger buildings with even less ductwork than they previously used. So it was a new technology. This company had to go out and invent it, come up with a factory, a distribution system, all because of building higher and trying to build more efficient generally. And so it's not just the skyscraper. What this means and what this tells us is a lot about the economy in general, that all these companies are inventing new products for the future. They're like future technology that they sort of know about, but they've never done. Well, once that skyscraper is completed, concrete companies and all the companies that work for them, electrical companies and all the companies that work for them, elevators and escalators and all the companies, they've all gone to the drawing board and they've all put the drawing board into action, all this new technology, which is usually great and it's all fascinating, but it's all something that otherwise would have come to us in the future. And when the economy sinks and nobody's building anymore, those companies are going to be hurting. They're going to be suffering. They're going to be restructuring. They're going to be laying off workers, going bankrupt. Who knows? But again, the skyscraper's symptomatic of what's going on throughout the entire economy. It's not just skyscrapers, but we can see skyscrapers and we can see their magnificence and their technology. We just need to be able to extrapolate that to the rest of the economy. So that's what's really going on. That's why the record-setting skyscrapers have had such a great record.
It also explains some of the other ifs and buts and T's and C's, I say, in the UK, that you have in the theory, such as the livable space, the usable space is the key. And it's because the skyscraper was built in order to be used, in order for the theory to be relevant. I think the easiest way to understand this for me is that interest rate's the price of debt. So if the interest rate is artificially lowered, it encourages projects that use a lot of debt, and there's no project that uses more debt than a construction work, such as a skyscraper. I was also thinking in my own situation, I'm looking to buy a house, and if land prices continue to go the way they will, I might be buying some sort of flat instead of a house, because that land is just so expensive. And again, that's the connection to the interest rate. The lower the rate,
it is right. It is right now.
Yeah,
a lot of things. Assets are highly valued throughout the world economy. People are seemingly desperate to get into real property and lots of other things that are real because they're so worried about the monetary unit. But they're also able to do it because interest rates are so low in the Western developed world throughout. The Fed, the Bank of Canada, the Bank of England, the European Central Bank, the Bank of Japan, and just any country you go to, you're going to find the exact same thing. The cost of borrowing is really low. And a lot of people are worried about the value of the dollar, the value of the euro, and so on. And so, real property, real assets right now are the way to go. But that is, what we've seen is that, of course, the crisis brings all of those things back in the direction of normal, including houses and flats and everything else.
Yeah, I want to quickly dig into that a bit more, because there's this connection between what booms artificially in the boom and what busts, consequently or subsequently. And I remember from your book that the Empire State Building was called the Empty State Building. And I'm assuming that's the connection.
Oh, yeah, absolutely. It's very rare that the biggest winners during the boom are not some of the biggest losers in the bust. They've taken on a lot of debt, so they're highly leveraged. All of their internal financials are geared towards that. They have a lot of new technology and new products that are eventually going to survive in somebody's hands, but they're going to go through a period of adjustment and retracement that's going to mean that a lot of that falls heavily. And you can verify this by looking at stock index. If you look at a tech stock index, you'll see the variation is much greater than the utility stock index, which has very little variation, and other indexes as well. The tech stock indices are always going to be more variable. They're higher risk, they're higher returns when things are going well. And the skyscraper curse actually, can be used to forecast, to invest in those things. So if somebody breaks ground legitimately on a new record-setting skyscraper, that's no time to get out. That's the time to plow it in. Just keep your eye on the sky for that record-setting building to reach that record height.
Before we dig into that sort of practical side and usable side of this index, which I'm sure the viewers are dying to hear more about, given what's going on in the world today, I want to quickly talk about Richard Cantillon, who you sort of point to as the first person to understand a lot of this interest rate artificial stimulus side and the effects, which is why we call them Cantillon effects. Do you want to tell us a bit about him, because he's a great character as well?
Yeah, Richard Cantillon was born in the 1700s. We don't know when. He was Irish. He moved to Paris, where he took over his uncle's bank, and he became one of the world's wealthiest persons during the South Sea bubble of 1720. And in his leisure, because he was so wealthy, in his leisure during the 1920s, he put together a manuscript on commerce in general. And we've recently retranslated that in English to economic theory, because that's what he was doing and that's what he did. His manuscript taught Adam Smith and David Hume, the physiocrats, and all the beginnings of economics. And one of his great ultra-modern contribution is now referred to as Cantillon effects, because he was the first to show that if you have increases in the money supply that are going to impact a certain sector of the economy, that sector and its owners are going to have a very heavy influence on the economy. They're going to change the structure of the economy. And when that new money goes away or is used up, there's going to be a crisis within the area that it first stimulated. So there's this notion that Cantillon provided that low interest rates could get people in over their heads in their particular businesses, and that whatever they were in at the time, he used the example of a silver mine, That's going to change the economy. And if that money goes away, there's going to be a lot of economic hurt that results from that. So he really had a rudimentary understanding of the business cycle and how money affects it. And he also showed that new money can have a positive or a negative effect on interest rates depending upon who has that money. In other words, if borrowers already have the money, that's one thing. If spenders have the money or consumers have the money, that's another. So it all depends on where the money comes from and who gets it. And then from there, you can diagnose what's actually going to happen in the economy.
So can you update us on what's going on now, not just regarding the skyscraper curse, because that, like you say, is just the most obvious symptom of what we're really talking about, which is the Austrian business cycle theory and the Cantillon effects. Can you update us on what's happening now and how it applies to what investors should be doing?
Well, like I said earlier, I've been paying attention to a project that had broken ground and was under construction in Saudi Arabia called the Jeddah Tower. And it was going to set a new record, being 1 kilometer tall of livable space. So that would have done it. But in Saudi Arabia, they basically put in prison the owner, the builder, and the financer of that building, and the project came to a stop. So I estimated when it would have been completed, and basically I was anticipating an economic crisis going into the year 2000. The numbers were
into the year 2020.
2020, excuse me, yes. The numbers were ultra great at the end of 2019, and they started to corrode going into 2020 in terms of job openings and all sorts of micro statistics. And then COVID hit and kind of threw the story out the window, so to speak. But more generally, since the financial crisis of 2008, the world has been flooded with money. The world has been flooded with near zero interest rates and a lot of odd, once in a lifetime, first time in human history type of stuff like negative interest rates. And so the picture has been very clouded with respect to the skyscraper curse, because there are a very large number of buildings that have been built and completed. There are a bunch more that are under construction, still more in the planning stages. The world is building into the skies, but as of yet, I have not identified any one skyscraper that plans to set a new record height. But so that doesn't give us a clear skyscraper curse signal. But what it tells us is that the world is building an enormous number in New York, in Europe, in Asia, in China, just everywhere we look, Cambodia. Everybody is in on it. So it's obviously an important structural trend that we're watching. And I attribute it to the fact that people are less concerned about, being number one in the world, and they're more concerned about creating real tangible property that will stand up, so to speak, in terms of being a real asset that has tenants and has income and that sort of thing, and is an inflation hedge. I think that's what it tells us, is that the world from, say, 2010 to 2020 and beyond, that the world is putting massive amounts of real resources into skyscraper construction, and they're doing it as an inflation hedge. They're not doing it as a result of highly speculative, exuberant behavior. And I think that a lot of this is more defensive related building.
Yeah, so it's important then to remind everyone again that not all financial crises were predicted by record-breaking skyscrapers. It's when there was a record-breaking skyscraper. So we don't have one right now. The Jeddah Tower was the closest one. But the same forces and understanding of the economy that makes the skyscraper curse so valid could still be playing out right now in this record stimulus. It seems to me, though, that we might be on to the next phase, the bust phase, as of the last few weeks, with central banks planning on reducing the amount of stimulus that they're putting into the economies, I think at a record rate. And I think it's 4 times as fast as they reduced stimulus going into 2018, 2019, which you just mentioned earlier. So it seems to me that we might be looking at the latest bust without the skyscraper signal having gone off. Are you getting worried about that?
Oh, yes. As a matter of fact, I agree with you. I think that the world is reacting to this and other things, other political events. But the UK has signaled higher rates. The U.S. Federal Reserve is signaling higher rates, and that's not everybody's expecting it, and yet the stock averages are performing very badly under those conditions. I have no expectations of some kind of crash, but I think a bear market is very much in the cards, and that could be an extended bear market until and unless they get to the point where their hand is forced to subdue inflation in the pocketbooks of the average person, that will have this slow process where the media reports the Fed wants to raise rates, and then they report something the next day, well, maybe we'll delay it, or maybe we won't do this. So it's been a non-event so far, and stock markets have not reacted very well to it. And right now here in the U.S., that's the news story, going home, on my way home, that, that's the whole thing, is people's expectations right now. They're looking at the Fed and how much it's going to do and what impact it's going to have on government bonds and all the rest, because they know that matters. They might not be aware of the skyscraper curse and a lot of other things, but they do know that when the Fed raises rates, everything gets tough on Main Street and on Wall Street.
I think I want to close by giving the book a great compliment here, which is that for people who like carefully argued but easily understood work, this is an excellent book. It's an excellent introduction to economics. It's the sort of thing I'd give someone as a gift who's slightly interested in these things, because there's no jargon. It makes perfect sense. It's very easy and fast to read. It's quite funny in parts. There's a bit of irony and sarcasm, I think, that I enjoyed a great deal. And perhaps best of all, what is the price, Mark?
Well, if you're here at the Mises Institute, it's $10. I think Amazon sells it for $20. But we also give away electronic versions of the book with the idea that we sell more books when we allow consumers to look at the books first. So, go to Mises.org, MISES.org, put in my name, Skyscraper Curse, and PDF, and it'll pull up our page where you can download the book for free. You don't have to register anything. It's great, and more people have been able to read it and get it out to other countries, because Amazon is great locally, but the further away you go, the more difficult it is, and the delay is longer. But tonight you can just download that PDF and take a look at it for yourself. And is this book worth reading? I really appreciate your comments on that. We spent a lot of time trying to get rid of the jargon and the technical stuff and get to the brass roots of it with things that people could understand. And so I really appreciate your comment about that. And it's been great being on the program.
Yeah, my own journey to Austrian economics started with a PDF, a free PDF from the Mises.org called "What Has Government Done to Our Money?" It led me a long way. It led me to a lot of your work as well. Mark, thanks very much for joining us, and everyone at home, please do check out the book, the free PDF version in the link below. Thanks very much for watching.